we are standing basically, a week out from what I call the event horizon of a black hole. In my mind, and I will give this advice to people, anybody who asks me, I'm going to give them this advice. If you're in contract and you can get out, do it. Do it. This is not the time to be in contract because it's possible that you can pick up the same property for 10% less in 90 days.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 220. This coronavirus pandemic has changed our society and the way we live in a very short amount of time. Those of us who own investment property can't help but ask, how bad will it get? What does this mean for my investments? And will there be new opportunities that arise from these unfortunate circumstances? There are so many opinions and overnight experts sharing those opinions that it can be difficult separating the good information from the bad. That's why I'm excited to have Neal Bawa on the show today. Did I say that right, Neal?
Yep.
Great. Neal Bawa on the show today in order to cut through the clutter and give us a clear-eyed perspective on what we can expect. Neal is not only a real estate expert with over 250 million portfolio of multifamily, mixed use, and self-storage, but he's also a technologist who successfully applies data science to his systems and processes. Neal is the CEO and founder of Grocapitus and Multifamily University. He's also known as the Mad Scientist of Multifamily. And you're definitely going to want to pay attention to what he's sharing with us today. Neal, welcome to the show.
Thanks, Brian. Thanks for having me on the show. And it's great to be with you again, though virtually this time.
Since I met you over a year ago, I've always wanted to have you on the show. I guess it's both unfortunate and fortunate for our listeners that it isn't until this coronavirus pandemic has hit us. Today it is Friday, March, what is it, 20th? Friday, March 20th. This episode will come out on Monday in 3 days. And, I think the question on everyone's mind right now is just how bad is it?
I think the answer to that question is it depends on how quickly we can come together as a society. How quickly can we come together as a political system? Because the projections are for a really, really quick, extremely deep, very painful, but very short recession, a worldwide recession. That could be over basically late in Q4 or beginning of Q1 next year. If we can come together as a society, if we can stop this virus, if we can understand just how destructive this virus is and take all of the necessary painful measures, the sort of measures that my home state of California took last night after the webinar. I was doing a webinar with 500 people watching, and I was talking about the potential for lockdown happening over the next week in more states in the US. And my own state implemented it basically within 30 minutes of the webinar finishing. If those kinds of courageous steps can be taken, our Delta might resemble China. So I want to start off by giving you some good news. The bounce back in the Chinese economy has surprised everyone. It surprised me. Not only did the Chinese, once they could come out on the streets, start buying, it seemed like there was pent-up demand. They went straight for the expensive stuff. They started buying, the Gucci bags and all of the Fendi stuff. They went a little nuts in the last 3 or 4 days as the Chinese economy reopened. Their industrial capacity bounced back to 85% within 3 days. A lot of great things happened. So I looked at it and I said, wow, this isn't like previous recessions. There's no benchmark here compared to 2008 or 2001. This was like an off switch and an on switch. And I'm excited about that because the Chinese are doing what we're doing. They're also plugging massive amounts of money into their system. They did, quantitative easing and interest rate cuts. They did all of that. But then the on switch was so quick, so rapid that today every Apple store in China is open. So I think that's the good news that we have to start with, that the bounce back from this can be quicker than any recession in history. And then we can talk about the really bad news, which is that the downside is greater than any other recession in history as well.
And let's talk about that downside, because I know you apply data science to, and you look at the numbers and the actual data. What is the data telling you about how deep this could go?
So I became fascinated with what I was hearing in the media about a month and a half ago. And I realized that the media itself, basically listens to all the other media, and they say stuff that often is outdated. And here's a reason why everything that we know about coronavirus is outdated. Everything. The reason for that is human beings are used to working on a linear scale, right? A linear scale is either 10, 11, 12, 13, 14, or it's 10, 20, 30, 40, 50, 60. That's what we're used to using. So our minds, including the minds of the experts in the media, are designed to work in a linear scale. Well, this virus, though, doesn't work on a linear scale, right? Yesterday, I gave you an example in the webinar that you were watching, and I said, if we're the Avengers, this thing is Thanos, and Thanos wiped out half of the universe. Well, this thing can wipe out close to 10% of humanity if we don't take it seriously for a number of reasons, and the economic impact is going to make it seem like it wiped out half of humanity. So it's very, very important to understand that this is the most aggressive and nimblest opponent that the world has ever faced. Because even in World War II, men faced other men. This is not like that. This thing can simultaneously attack 173 countries, can replicate itself endlessly, and move at an exponential rate. And so it's super duper important that everyone understands that we've never fought anything like this before. And here's an example, okay? Exponential growth means that the virus doesn't go 1, then 2, then 3. It doesn't go 1, then 10, then 20, then 30, then 40. This goes 10, 100, 1,000, 10,000, million, 10 million. So the speed at which the virus grows is something that we've not understood. So immediately in late February, we created a website called coronavirusrealestate.com, and eventually we kind of started putting less real estate content on it. And I just started focusing on the data science of the virus. So if you go there, you'll notice that there's a Google spreadsheet that is embedded into the website. Right? So you go there and you notice that the Google spreadsheet is tracking the daily growth of the virus in the United States, in China, Spain, Italy, France, Germany, and a couple other countries. And the reason we are doing that is to show people that the growth rate of this virus is so phenomenal that everything that the media says and everything that the politicians say is outdated at the moment that they're saying it. Because it's moved on. It multiplies extraordinarily fast. On March 1st, there were 75 cases in the United States. We're now right around 9,000 cases in 20 days. So it's got basically multiplied more than 100x in the last 20 days. And the way politicians work, 20 days is a very small amount of time. They can't really react in that time frame. They were never designed to react in days. But the problem is, to fight this thing, you have to react in hours, not days, because days is too long. Because it multiplies too fast. It changes things too fast. And so understand that what we are about to talk about and the numbers that we're about to talk about are based on this exponential growth of, 10, 100,000, 10,000, 100,000 million. And we have to adjust our minds to that because our enemy is working at that speed.
Now, in your webinar that I watched last night, and maybe our listeners will be given access to that too, that would be fantastic. You outlined two different scenarios, two very distinct scenarios, scenario one and scenario two. One is kind of the worst case and one is not as bad of a case. Can you give us a summary of each?
So scenario one is what you call the worst case, Brian, but the only problem is that today that scenario is the current case. Even though it's worst case, it's the current case. So I'll pull those up in just a second because I don't want to miss any parts of that. So give me 5 seconds so I can give you the exact information about those scenarios. Let me see where they are. Come on. So here we are. So two scenarios. In the first scenario, we do what is known as containment and care. Right now, we're in containment and care where we are advising people to stay home. But I showed you a video yesterday that showed that the beaches of Florida and the beaches of Georgia are flooded with massive numbers of people. Bars all over the US, in many parts of the US, are filled. And so we are in a containment and care scenario. In this scenario, there's no national quarantine of the sort that Spain or Italy or China implemented. There's no national lockdown. People can still travel. Domestic airline travel is still allowed. Airports are open. In this scenario, and this is not my thought. This is the UCSF Biomed panel. These are superstars that of a viral and infection control, and people that have fought Ebola and other dangerous viruses before. And they believe that 40 to 70% of the US population will become infected over the next 12 to 18 months. Last night, even an hour before he announced a statewide quarantine in California, our governor said that by May, 56% of California's population would become infected. So in that scenario, if the virus has a 1.5% mortality rate, and by the way, I'm being overly bullish because in Italy it's 8% and China was 3.4%. At 1.5% mortality rate, it will kill 2.4 million Americans in the next year. And after that, we'll start to see what is known as herd immunity, which is a very useful thing that reduces the effect of the virus. But by the time it does that, it could have killed between 2.5 and 8 million Americans. That is the worst case scenario, but we are on worst case scenario right now. And what we are hoping, and we are very pleased to see that things are moving in this direction, is scenario 2. Within 1 week of yesterday, so by the 25th or 26th of March, we were recording on the morning, Friday, the morning of the 20th. Within 1 week, the United States starts putting large percentage of its population centers into full-scale lockdown. At this point, the only center in the United States that's in full lockdown or close to full lockdown is California, and it went in lockdown last night. The San Francisco Bay Area, it's 8 million people have been in lockdown for a week. So that kind of lockdown, it's called shelter in place, needs to be implemented. And it doesn't need to be implemented, by the way, all across the US, but places that are seeing massive outbreaks. And if you haven't, if gone to the Worldometer website, so worldometer.info website, you can see which places in the United States right now have largest number of outbreaks. It's very visible. I can tell you, here they are: New York, New Jersey, Michigan, California, Illinois, Louisiana, Georgia, Texas. These are the states with massive outbreaks and multiple outbreaks. The way that this virus works is you get case, cluster, boom, right? I can tell you, Brian, that all of the states that I named have multiple booms. The boom is this day when you get hundreds and hundreds of cases, even though the previous days you might have had 5 cases or 10 cases. You get a boom. And New York at this point looks like it has 7 or 8 different booms going. They had 2,330 cases in the last 24 hours. The fact that they're not in lockdown boggles the mind. If we manage to do that and we take these centers that are the epicenter of this virus and we lock them down, in that case, we should see a drop in cases by mid-May. So sometime in mid-May, this thing flattens out, it drops. Our healthcare system becomes completely overwhelmed in this scenario too, but we are taking aggressive and smart measures. The president is talking about taking over ventilator companies. That's a very smart move. We're going to, basically do wartime, manufacturing of masks, of gloves, and of protective suits. That's a very good idea. We are requisitioning Carnival Cruises' entire fleet, and they're going to park one of these ships off the coast of each one of these major cities. And now you have a hospital with 3,000 or 4,000 rooms. That's a very good idea. We will find ways to fix this thing in scenario 2. But scenario 1 massively and utterly and completely overwhelms our hospital systems.
Right now, it's Friday, March 20th. This will come out Monday, March 21st, 22nd, 23rd. Do you anticipate us being in full lockdown by then?
I anticipate the state of New York to go into a full lockdown between the time that we're recording this and Monday. Because and the math there is unstoppable. I mean, they cannot wait. They must not wait they're going to turn it into a mass tragedy if they wait any longer.
And will that be enough? I mean, as far as avoiding scenario 1 and getting closer to scenario 2, will that be helpful, or will that still put us behind the 8 ball?
At this point, there's a desperate need to put New York and New Jersey into quarantine. I'm not so sure that there's a desperate need to put everyone else in. I think that Michigan, Illinois, Louisiana, Georgia have a little more time for their politicians to react. But in my mind, if you asked me, a week from now, what are the states that are going to go into quarantine that haven't gone into quarantine yet? It's New York and New Jersey, probably before this video is released, followed by Illinois, Louisiana, Georgia, and possibly Texas. Texas, obviously, from a political perspective, has great resistance to shutting down. So we'll see if that goes. Massachusetts is another state that could go into a full lockdown within the next day or two. They're politically aligned with California, so that might happen sooner. I'm very annoyed to see that politics is playing a role in this, and it really shouldn't. I mean, the virus doesn't seem to give a damn. So the fact that Democratic states appear to be more ready to go into lockdown and Republican states are not is somewhat annoying to me.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Let's switch over to real estate, because this is the real estate investor and rental property owner podcast. What does this mean for real estate investing? I mean, up until a week ago, and even still today, values are still high. Loans are still getting locked in or done. I know of some deals that are still getting done, but I also know some deals that have kind of stopped cold. What are you seeing out there, and what do you anticipate?
I was listening to the CBRE podcast, and by the way, it's a phenomenal podcast for those of you that want to understand the impact of this on real estate. So look for it. They did a flash podcast. It was not on the schedule. Then they just sent an invite out for a day before. So here's what I see. Number one, the drops in interest rates, the cuts that were made by the Fed to interest rates, that will help put a bottom under the single family market. But it is not going to prevent a price decline over the next 3 or 4 months. We saw this in 2008. It helped a great deal. It bought, values back, and obviously then created this massive bubble of real estate that we live in. But for the moment, for the next 3 or 4 months, what is going to be dominant is fear. What is going to be dominant is confusion and people second guessing themselves. So here's what you can expect to see for single family over the next few months. So let's go single family first, and then we'll go into commercial and multifamily. Sellers are going to be reluctant to list their homes because they don't want strangers in their houses. The National Association of Realtors is now saying that 1 in 2 sellers nationwide are either backing off from selling their homes, or they're changing how their homes are shown. They're saying, either we don't want buyers coming in, or they have to wash their hands and use hand sanitizer. They're asking buyers to remove shoes. Many of them are saying, I don't want any of that. I just want my home shown virtually. So obviously that slows down transactions. And then home buyers are going to say, I'm going to postpone my decision because I don't know if the Fed's going to turn, cut rates again, and if the rates are going to go down. Buyers play this mental game of, our rate's low enough, and they're going to start paying more of that. And they're going to physically be afraid to go into homes. The California Association of Realtors is reporting that 46% of buyers have backed off in the last week and a half because they're afraid to physically go into homes. So bottom line, you're going to see a massive decline in sales volume. I'm not talking about pricing. So please keep in mind, I'm not talking about pricing. I'm talking about volume. Okay. So imagine what happened with the airline industry. As of today, 80% of the airlines industry schedule that's domestic has been cut, 90% international, right? Now, in their case, when they cut the schedule, it affects both their volume and their pricing, right? So right now I can afford to go to Puerto Rico for $55 from the San Francisco Bay Area, $55, right? That's just ridiculous. So In the case of homes, though, because real estate moves slower, which is a great boon, by the way, that it doesn't move like the stock market, every 5 seconds, we're unlikely to see price declines. We are likely to see a massive decline in inventory and in volume. Inventory meaning sellers are not pushing new homes in, and volume meaning buyers are not picking up those homes. So we're likely to see that for the next 2 months. But then starting June, I do expect to see price declines. In what number? That really depends on how well we do with the coronavirus. But if scenario two, which I'm hopeful is what happens, then perhaps a 5, 10, 15% decline on the single family side. So that's what I see for single family, Brian.
What about rentals? We have a lot of tenants who are not working. They're going to have trouble paying their rents. How do you see that affecting both the single family rental market as well as the multifamily rental market, which I know you have a $250 million portfolio of?
On the single family rental side, here's the first thing that you should know. Number one, single family renters have more money in the bank than multifamily renters as a group, right? So I'm averaging it out across 10 million home people that are renting single families. And there's no doubt in my mind that they're more affluent. So it actually will take the single family market more time to get hit on the delinquency side than it takes the multifamily side to get hit. So keep that in mind. They've got more money. They're more attached to their homes. They're less likely to stop paying just because they've lost their jobs. And some of the people that are living in single family rentals do not have the low end restaurant jobs, working at the airport, working at Starbucks. There's less of those people that do that because then they couldn't afford single family rentals. So number one, the impact there is a little bit slower. And let's assume for a moment that everyone stops paying, which is not going to happen, but let's assume everyone stops paying on April 1st and you don't get your rents. Well, then very, very quickly, within the next 15 to 30 days, you will notice that your lender is sending you emails saying that they've been approached by the feds and are open to you filing. Here's a form, fill it out so you can defer your mortgage. So it is not possible for state after state to start announcing you cannot evict people and then not announce that you can defer mortgages. So right now, I assure you, every mortgage in the US is working on deferment of mortgages. So the single family market will end up deferring their mortgages. And deferring doesn't mean forgiveness, Brian. We still have to pay our mortgage. But it means that let's say we defer for 3 months, right? Which is the most critical 3 months, April, May, and June. Let's say we defer those 3 months. Those 3 months get added to the end of our mortgage. For single family, it gets added to the 30th year, which is, maybe 20, 30 years from now. And for multifamily, it gets added to the 10th year. So either way, if there's large scale defaults that are going to a large scale delinquency that's going to occur, which I predict it's going to occur, we will have tools at our disposal as landlords. So don't think that we're completely weaponless in this fight. No, we've already seen movements. CBRE, Marcus and Millichap are already activating their lobbies at the federal level, asking for there to be loan forbearance. And even they're going beyond forbearance. They're saying that we as an industry should get the sort of handouts that you're about to see to the airline industry.
That's a new information since your webinar last night.
Correct, because last night, at the same time that I was teaching the webinar, the real estate lobbying industries were meeting and they put together their requests and they're actively lobbying for a bailout today. And I think that we may not get to free money, but we may get to lots and lots of loan forgiveness and forbearance. Forgiveness is very difficult at this point in time, but forbearance is certainly possible, pushing it out into the future.
Just to repeat, for multifamily and apartments, what you see and what Marcus and Millichap and other lobbyists are lobbying for is to take maybe the next 3 months of mortgage payments and defer that toward the end of your term.
On a case-by-case basis, right? So we have to prove that there is actual delinquency. So we for example, if you're a single-family landlord, I think that within 45 days you'll be able to approach your lender and ask for something, and I think that lenders are going to be open to it. That's what I feel is about to happen. Nothing like this has happened. I mean, did you notice how quickly things have moved for the airline industry? 40 days ago, the airline industry was still cutting schedules by 10%. Today, they've cut 80% domestic, 90% international. And already there's wide acceptance in Congress that the entire industry has to be bailed out. 30 days, right? So the same sort of thing will happen, but for real estate, it's not this 30 days because nobody has defaulted on their loan on their rent yet, because in early March there wasn't enough knowledge of this crisis for anyone's mindset to be changed. And there still won't be full recognition of this crisis the time comes around for April rents. It's going to be May when you're going to see large scale delinquency, and by that time we'll have tools to manage it.
What do you see with property tax? Because that's one of the other big ticket items when you look at your expenses is property tax. What will states, municipalities be doing about that?
Same sort of thing. I believe that within 45 days to 60 days, we will get the ability to defer property taxes. Please note that some of this is already happening. So businesses are now allowed not to pay up to $20 million of taxes that was due. And small businesses, of course, will take huge benefit out of this, because instead of paying the government their 2019 taxes, they can use this money to pay their employees, right? They can use this money to pay for other expenses. The same, you'll see a cascade effect. You'll see property tax authorities declaring a property tax holiday or forbearance where you can not pay them for 3 or 4 months. I think the only industry that is unlikely to issue that kind of a holiday is the insurance industry, because it doesn't make sense to do that. You don't want to stop paying your insurance. But I think on the property tax side, on the mortgage side, within 45 days, I expect that both on the single family and multifamily side, we will have lenders providing us online portals and forms to do forbearance.
Speaking of insurance, I spoke with my insurance agent yesterday just to see, okay, how are we covered on our multifamily? And the answer is we're not. And I'd imagine that's probably what most investors are hearing about their commercial real estate.
So there is a way for us to get around that, and that is what our lobby is working on. Do you remember that our insurance has an Act of God section, right? So there's a clause called Act of God. We are, not just us, but every kind of business in America is going to lobby Congress to make coronavirus an Act of God event, in which case it becomes part of our insurance. If that happens, everybody benefits. Insurance companies get slaughtered.
Yeah, we'll see if that
they do have one of the strongest lobbies out there, so I'm not suggesting that that's going to happen.
Yeah, I'm not going to hold my breath till I get my insurance check. Just as our residents are going to get relief, possibly money from the government, we'll see what happens. It sounds like people do understand, our elected officials do understand that multifamily owners need that same relief as well.
Yeah, and what's important is that when you think, let's go back to that relief that you just discussed. This is not about multifamily, but we are the biggest beneficiaries, and I'll tell you why. So a family of 4 is likely to receive $3,400 of relief. Okay, and how does that calculate it? $1,200 for the male in the family, $1,200 for the female in the family, $500 if they have 2 kids. So I'm assuming if you look at an apartment, the very common average scenario is a family of 4. Well, that family of 4, if they live in an apartment, then it's very likely that within the next 30 days, they will receive $3,400. Now, the average rent in those multifamilies is somewhere between $900 and $1,100 a month. So when you receive that $3,400, Brian, one of the first places that you're likely to apply it to is the roof over your head. So I want to point out that multifamily, single family rentals are actually going to be one of the biggest beneficiaries. I know they're going to go out and buy groceries first. And of course, before they buy groceries, for some reason, they will buy toilet paper, which I don't understand at all. But apparently toilet paper is the new gold, right? So instead of buying guns, bullets, and gold, you go out and buy toilet paper. So whatever. So they will, once they're done buying toilet paper and buying groceries, they still have a bunch of money left over, because how much groceries can you buy? There's only so much that your fridge can hold. And so beyond that point, I believe that rent is the next known, application of this money, which makes all the sense in the world. So in my mind, when people are like, I get laid off, what do they say the first thing? I can't make rent, right? So $3,400 for a family of 4 that lives in an apartment is going to come in from the feds in the next 4 months. It's a big deal. It's a huge amount of money. It's multiple months of rent even after they pay for groceries and toilet paper.
Based on that logic, you would think, okay, our residents will be able to afford rent. Plus, we may, as multifamily owners and operators, get forbearance on our mortgage payments for a few months as well.
So the answer is you can't have both, right? If they're going to pay you rent, your bank's not going to allow forbearance. If they're not going to pay you rent, that's when you have a case for forbearance, because you can't send a rent roll to your bank saying, "Oh, everybody paid. Can you give me forbearance?" That's that's not going to go over well, right? That conversation stops right there. But if the question is not whether they can pay, because I think that money is imminent. Congress is doing a good job. Thank you, Congress, of moving very quickly on that package. I think it's going to get passed by Tuesday or Wednesday at the latest by both the House and the Senate. The president already said he's ready to sign. And so I think we get money into the hands of people 30 days from today. And if that happens, they can pay. But Brian, here's the problem. Will they pay? So you're living in one of my apartment complexes. You're a family of four. You get your $3,400. And now you're thinking, I don't know how bad this thing is going to be. I don't know how long it's going to last. I have the money in my pocket. Should I just leave it in my pocket and not pay because my landlord cannot evict me? Because I can pretty much guarantee across the board, we might even see a federal mandate against eviction in the next 30 days. But certainly state by state, for large metros, we're going to see those mandates. And just so you know, we've called the sheriff's office for evictions that we already had lined up in the last 4 weeks. They refused to come out already. By the way, there was no legal reason for them to do that, but they're using the coronavirus as an excuse to simply stop coming out.
What other danger points are there for residential or multifamily owners that we should be anticipating?
The biggest one is infection. You really have to lock down your communities. You're actually in charge of your communities, and how safe they are is totally dependent on us. We've locked down. We've put yellow tape around every playground. We've locked down gyms. We've taken away the cookies, the donuts, and the coffee from the clubhouses. We've shut down the clubhouses. We are repeatedly telling tenants to stay in their homes. And most importantly, we are being very cautious with our maintenance staff, which goes around to everyone's unit. The biggest problems that we're having is we can't find enough gloves. We can't find protective gear. We can't find masks. And so that's hampering our efforts. But our biggest risk is that our community becomes an infection source. Because remember what happens: case, cluster, boom. You could go, to 100% vacancy in 2 months because people will simply leave. They're not going to say, they're going to say, I'm going to worry about my rent later. I'm leaving because this place is infected.
What about shared laundry rooms? What's your process there?
So that's been an area of discussion. It's an area of vulnerability, and we can't shut down those laundry rooms because people need them. And so at this point, they're open, and we're still scratching our heads going, how do we make this place more secure?
Let's talk about other asset classes. You did a great job in the webinar last night, kind of breaking down the most vulnerable asset classes to the least vulnerable. Are you able to give us a rundown of what that list was?
Absolutely. I have it up on my other screen here. So
Great.
One of the best ways to understand which asset class will get hit the most or the least is to actually look at what is known as REITs. Real estate investment trusts are these billion-dollar roll-ups of some kind of property class, like senior housing, skilled nursing, hotels and student housing and multifamily and all sorts of asset classes. They're roll-ups, right? And they're public. And so when you look at their stock value, how much it has declined in the last 20 days, you get a really good understanding of what, number one, the market is thinking, and number two, the people that control billions of dollars are thinking, right? It's what is their initial thought? So it is not surprising at all that the biggest hit so far has been senior housing and skilled nursing. We had this case where we had this facility. It was in Washington State, and it had 130 cases. As you can imagine, because that thing was all over the news constantly, people are afraid right now of putting their elders into a skilled nursing facility, into a senior housing facility. So not only is no one going into those facilities, a lot of people are coming out. right? So people that are in there are like, these places are like infection. I mean, I'm going to die. I'm going to go live in my son's basement for the next 30 days, but I'm not living here, because if I live here, I'm going to die, right? So in the short run, the stock for senior housing is down almost 50%. I mean, it's down almost as much as airlines. And that makes sense. A lot of it is, paranoia, obviously. But until the infection rate dies down, if I had my dad or my mom in a senior housing facility, I would be driving there right now, even through a lockdown, to get them out, because their chances of getting infected there are dozens, if not hundreds of times higher than in in a bedroom in my house. So they got hit the most. Next was hotels. That makes perfect sense, right? So at this point, hotels are empty. A lot of hotels have even offered to turn themselves into makeshift hospitals, which is a really good strategy. I think this is how we're going to fight it, war style. And part of that is the cruise industry, which sometimes gets clubbed under hotels because they're hotels that are floating. And so that industry has seen a massive decline in its revenue. At this point, I believe all cruise lines in the U.S. are shut down, and there's no active work there. So their revenue's gone down to zero, and so their stock's been hit really hard. Student housing's been hit really hard, because if you're going to take every single student, and I think 50% of all U.S. students are now at home. If you're going to take all of those students out, then that's going to have a massive impact on their revenue. And so that market has been hit. Malls have been hit next, and I'm surprised malls are not hit more. They're only down about 30%. I would have expected that they would be down 40 or 50%. Strip centers and malls are really going to lose quickly, because you think about us in multifamily, we haven't lost a buck yet. You think about rentals. No one in the United States has lost their first dollar yet. But imagine what happens if you were a strip mall and you had tenants in there. Those tenants lost 100% of their revenue. Your property is basically looks abandoned. Everything's shuttered. And you know that there's very, very little chance that anyone is going to pay your rent on the 1st of April. So those areas got hit, and I don't think that malls and strip malls have been hit enough yet. They will be hit more. Office down about 23%. And initially I was like, what? That doesn't make sense. But then I realized a lot of office space in the US are larger companies. They're well capitalized. They have a lot of money. They're unlikely to not pay their April 1 rent. Maybe they won't pay in June or July if this thing drags on. But I don't think that they're going to stop paying in April just because they told their employees to work from home. So smaller offices are likely to get hit. Larger offices, not so much, at least not in the April-May timeframe. So we saw a 23% decline there. Apartments went down 23%. I was a little surprised by that, but I think that people don't understand that we are going to be the primary and the first or second beneficiary of this free money that the government is about to distribute, right? It's a huge amount of money, and we're about to distribute this. The moment they take care of the food, they're going to pay their rent. So I don't think that apartments deserve to be down 23%, but I'm really glad we're not down 49 or 50% like the senior housing space, or down like the lodging, the hotel space. So those were some of the buckets. And on the bright side, single family rentals only down 18, 19%. And that makes a lot of sense, Brian, because as I said, the people that rent single family homes have more money in the bank and are more attached to their single family rentals than the apartment rentals are. And they also don't have this fear that apartment renters have right now, which is, if this place gets infected, I'm leaving. I'm going to go live with mom, right? Well, that doesn't happen with single families because you're in your own bubble. And so I think that even minus 19 is on the higher side. I think that they should only be down 10%. I think the single family rental market is protected for the moment. And then we saw the superstars, the ones that were doing the best: medical offices and self-storage. Self-storage, obviously, everybody knows this. By this time, it's the most most resilient asset class. Why? Because when you're worrying about whether I should pay $1,000 in rent, you don't even think about the fact that there's an auto deduction going out from your bank for $80 for your 10 by 10 unit. You don't think about that for 2 months, 3 months, 4 months. And just the hassle of having to basically save that $80 this month And then having to go and find a car and then take all that stuff out, and then where do you put that stuff? You can't put it anywhere else. So I don't think the storage industry really gets hit. I don't think their revenue is going to change at all in the next 2 or 3 months. They may not get new revenue, but their existing revenue, that people will keep paying them, which is why of all asset classes, self-storage has been hit the least. But I think that medical offices, even though they got hit the next least from self-storage, should have been hit even less. I think, and here's a prediction, Brian, over the next 30 days, that vertical, medical office, and the life sciences verticals may actually be the only one in our sector that goes positive. It's going to go up as people realize that, like 9/11, this is a paradigm shift. When we are done with this thing, we're going to need a lot more medical offices. We're going to need a lot more life science offices, because you saw what happened after 9/11. The area of security, information security, physical security saw a 10-year boom. Well, we're about to see a 10-year boom in anything that is related to infection control in healthcare. So I think that area is one that, if there were medical office REITs, I'd be buying them. In fact, right after, in the middle of this day, I have people doing research for me on what I can buy. I want to buy medical office REITs, not apartment REITs.
One of the other opportunities that you mentioned last night on the webinar was buying up distressed office buildings and converting them to medical office buildings.
That's what I plan on doing, but I can't do that today because the distress isn't there, right? So I think that it's going to take 2, 3, 4 months for the distress to happen in the office sector. Not all of those people that have left will come back. Why? Because companies are taking hits. There are a lot of companies whose revenue in April is going to be down 80 or 90%. They're not going to, if they had the option of letting go of some leases that were coming up for renewal, they're not going to renew them. So smaller offices are going to see some defaults, and I'm going to be first in line to pick some up. I'm very bullish, by the way, in terms of syndicators. I mean, if you're a syndicator, right now is a time to be fearful, but 2 months, 3 months from now, you and your army of investors should be buying a lot of stuff.
And I want to get into opportunities that you see, but first I want to address our mobile home park investors. Mm-hmm. Where do they fall on your list of trouble?
So they were in the middle, and I feel like that was unfair. I don't think that mobile home parks suffer as much. I feel like those are the people that are going to pay their rent when they receive the free money from the government. So it was down about 28%, the same as malls, which I think is ridiculous. I think that is a better sector than that, and doesn't get as hit. I think it gets hit more than, let's say, public storage, but I do expect that sector will do well. It's not doing well so far from a REIT perspective, but I think a lot of that is just confusion and the fact that all ships are going down.
Let's talk about opportunity. When is it going to happen? And should we be looking for opportunity now, or do we need to wait for things to settle down a little bit more?
I'm going to go back to my technology roots here, Brian. We are standing basically, a week out from what I call the event horizon of a black hole. So my ability to make predictions is stunted by how we fight this virus in the next 15 to 30 days at a world level. I am seeing lots of encouraging signs. What California did yesterday was the right call, even though it completely shuts down the California economy, right? So the 6th largest economy in the world has shut itself down. California was about, half the size of China. So that's a big deal in terms of its economy. So I'm seeing encouraging signs. So if today is the time to do nothing, in my mind, and I will give this advice to people, anybody who asks me, I'm going to give them this advice. If you're in contract and you can get out, do it. Do it. This is not the time to be in contract, because it's possible that you can pick up the same property for 10% less in 90 days. So if you can get out of contract, do it. If you can't get out of contract, talk to your investors, because the biggest opportunity in the last 5 years is about to happen. And it may only happen for 1 quarter, which is Q3. Q2, everything's shut down. How many things can you buy? How many things can sell, right? So nothing is happening. The world is on pause. And I don't think it unpauses until the end of May or the beginning of June. So that's when you'll start seeing people realize that they have to start listing some properties that are in distress. So Q3 is the potential opportunity. Will that potential opportunity happen in senior housing? Yes, it'll happen in every one of the verticals that we just went through, because in every one of those verticals, there are some properties that had no operating capitalization. They were already doing poorly. And so the, people had used up their last dime at that point and now just have to sell, right? They have no choice. Their bank will say, you know what, you just have to sell, right? And so there will be properties coming on the markets. The same thing will happen for single family. So I believe across the board, there will be opportunity. But I think that you may hesitate before you pick up senior housing because that may be a long-term mind shift for people and it might take a while before those senior housing get filled up. But don't hesitate to pick up deals in public storage. Don't hesitate to pick up medical offices. Don't hesitate to pick up apartments, and definitely don't hesitate to pick up single family. So you see those opportunities, be ready. Your job as a real estate professional right now is to message your investors who are freaked out and make them understand, right, that Warren Buffett has always been right. When people are fearful, be greedy. When people are greedy, be fearful, right? This is a time when you should be preparing your investors for greed and for execution in Q3.
Anybody who is out there right now looking for deals, making offers, what do you say to them?
Stop or renegotiate. So a survey that CBRE did said that 50% of deals in contract received counter offers with 5 to 10% lower prices. 50%. In my mind, the other 50% are just lazy.
What exactly are you going to do? I mean, you just gave great advice for everyone, but what is your plan to take advantage of the opportunity that might arise from all of this?
I am gathering money. I've been very frustrated in the last 18 months that either I can buy over, super expensive assets at super expensive prices, or I can choose to just sit on the sidelines. And so I'm going to be extraordinarily active in Q3. So right now, I have a 12-person marketing team, and it's all about messaging. We need to get our investors out of this crazy fear mode. Right now, every investor is afraid, right? And they should be afraid. But over 8 weeks, 9 weeks from now, when we've plateaued and our caseload has plateaued, and the money that the government has sent has had an impact on the economy, we're beginning to hear good news. Our investors need to be ready to act, because I don't think that sharp dip downwards in the economy lasts more than 2 quarters. Why? Because the amount of stimulus that we are pouring into this thing is unprecedented. At 1.3 trillion, it's already double of what we did in 2008. The rate cuts being that we went to zero. Remember, Brian, it took about 7 months for the 2008 crisis for us to get to zero. We're already at zero 15 days into the crisis, right? And not only that, I'm seeing every other bank in the world react better, every other federal bank, right? So Bank of England cut rates twice. The Bank of Japan cut rates. Germany's cut rates. Everyone's doing stimulus. Remember, stimulus is different from rate cuts. Rate cuts take 6 to 9 months to get into the economy. Money gets into the economy the day you send the check. So an incredibly large amount of stimulus happens. So my message for everyone is the same as my message for myself. Wait and watch. If scenario one happens, guns, bullets are probably the best way to go. Gold would be nice too. If scenario 2 happens and we get control of this the way China did, then the world will go on. This will be a blip. We'll laugh about it in a year. But because of the damage that we are doing to the economy in March, April, and May, there will be lots of deals on sale. I'm planning to get a bunch of them.
And then long-term economically, with all this stimulus and lack of taxes being paid to municipalities, things like that, do you see more trouble? We're digging a deeper hole for ourselves further out into the future?
Man, don't get me started on that, because I think that the answer is, Brian, we've already dug a very deep hole. So there's no way for municipalities and the federal governments of the world to pay back their debt. They're at the point where they're having trouble paying back the interest on their debt, right? Not the debt, just the interest. So I think everyone that has any sense of macroeconomics knows that there will be something called the Great Reset, right? That will happen at some point. I believe it'll be less painful than most people give it credit for, because I believe all of the federal banks of the world have already prepared for it. They have committees preparing for a mass forgiveness of of debt all around the world. I think it's going to be a 50% haircut. And on that day, anybody who is a borrower will benefit, and anybody who's a saver in the world, and the majority of the world are savers, not borrowers, well, those people will get screwed. So it'll be the biggest theft in history. When it happens, could be 3 years out, could be next year, could be 5 years from now, could be 10 years from now. But I believe that the debt jubilee is our future. And all this does is it brings us closer to the day of the debt jubilee. If you don't know what debt jubilee is, please Google it. It's one of the most important financial terms ever, because every single person on this planet is going to be affected on that day. Debt, Jubilee.
Neal, how would people get a hold of you or find out more, and especially watch that webinar and keep up to date with the webinars that you're putting out?
I had insane demand for the webinar. There were so many people locked out despite our 500 user Zoom license that my email is filled with people flaming me. So we're repeating it again every 3 days from now until the end of this crisis. And every 3 days, the content will be new. We think that every 3 days we have to rewrite our presentation because everything that we said the previous week is now obsolete. And so we are committed to doing that. And the best way to get that information, if you're in real estate, go to coronavirusrealestate.com. If you just want general information, multifamilyu.com. So either one of those two websites works. If you want to read more about, we have updated daily graphs on how the US is doing versus other countries, and they're on coronavirusrealestate.com. But in terms of the general real estate impact, we published that on multifamily followed by the letter u.com, multifamilyU.com. And in case you're looking to invest with us, you can go to multifamilyU.com, fill out any form and let us know. Just so you know, we're not buying anything in the next 60 days, but we'll be buying a truckload after that.
Neal, I really appreciate you sharing this information with us. It's always great to get your perspective, on what's happening in the market, the economics of the investments that we're all making, and just what's happening with the coronavirus. Everything you shared with us has been very, very interesting, and hopefully it prepares us for what lies ahead. Thank you so much.
Thanks so much, Brian. Thanks for having me on.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.